start the chapter 6 handout. We will not finish that today. Monetary unit sampling, I don't think we're going to finish that one either today. But anyway, the Medtrans case we'll start out with, and so we'll definitely finish the Medtrans case today. So let's go ahead and pull that up. So go ahead and read through this. It doesn't take too long. Okay, so the Medtrans case. This is a very famous case. And before I get into the actual case itself, I want to talk about professional standards. There's a body of law of professional standards for people who are professionals, people like doctors, lawyers, therapists, CPAs. We are considered professionals, and there's some things and we're held to a higher standard. And one of those standards are that you have a duty to your client, that you can't leave them in a worse position than when you got them. And the idea is you're required to help them. you're required not to put them in a worse position than they were before. Let's think about like a doctor. Let's say a doctor, you're scheduled to do a surgery, and you do the surgery, and as you start doing the surgery, you realize that this person has a lot more medical problems than you thought. Now, can you just run out of the room and say, "Oh, I didn't expect that," and run out of the room and not do the surgery? Well, no, you do the surgery and you do as best as you can to help them at that moment. Maybe, have additional surgeries or something, whatever it is. But you can't just leave and not do the surgery, because this person needs the surgery, and even though it's worse than you thought it was, you're required to make your best effort to help your client. And so that's kind of the what we're under as far as professionals, and that's for all professionals, doctors, lawyers, whoever is covered under this professional umbrella. Now, this case really pushed that, and that you had a client that had cooked their books and was not going to change them, and the auditors found out that they were actually, instead of making 1.9 million, they lost 500,000. They were actually losing money, and the auditors withdrew from the engagement. Now, you might wonder, well, why did they do that? Professional standards say that they should withdraw from the engagement, and you say, well, why? This goes to our profession in that we give credibility to financial statements. Okay, so the AICPA says, look, you cannot be associated with people of ill repute. You cannot be associated with those people that lack integrity, because not only is it that whoever you're dealing with, but also the whole profession suffers if you're dealing with all your other clients. If you're dealing with this client that is not on the up and up, all your other clients, their credibility, the credibility of their financial statements comes into play, because all of a sudden, wait a minute, this is the same people that associate with bad people. And so the credibility is the problem. And so CPA says, don't be associated with them. You withdraw from the engagement, say, look, we're not going to deal with you because you're a bad person, and we can't be associated with that because it's going to hurt our other clients, who their financial statements are, they need the credibility of their financial statements for their getting their loans and investors and all that. Okay, so you have these two different views. You have the professional standards that say withdraw from the engagement, but then you also have the AICPA standards that say you should withdraw from the case, and then you have the professional body of law that says if you're a professional, designated as a professional by the state, that you have these other rules that say you cannot abandon your client. Okay, so they withdraw from the engagement. So the third successor, so this is the fourth auditors that come in, finally they make the adjustments, and they issue the financial statements, and they sell the company for $10 million less. And the jury sides for Medtrans. And the AICPA standards were not allowed to be used in court. You say, why? Well, here, the AICPA is just a club. So here's the problem. You guys say, well, this club I belong to says that we should withdraw. You can't bring that into court, this club doesn't like it. Well, on appeal, and I think because this case was such a miscarriage of justice, on appeal, they did actually say, they said, look, no, professional standards do matter. And that even though it's not necessarily part of the body of law for all professionals, that the AICPA's standards that guide professionals, that is part of it. So the main part of this case, what is the importance of the Medtrans case? And this is that professional standards
We can't see your screen, by the way, Professor.
You're right. Uh, this is just for me. This is only for me. Thank you for letting me know.
Yeah, no problem.
All right, so let's see here. So here's the professional standards set by the AICPA can be used in the court of law. And by the way, this has been actually expanded to other professionals. They have their own professional standards that are not necessarily state laws that so they can be used in court too. It's a very important case, and the importance of it is that it can be that these standards by the AICPA can be used in court. And again, up until that time, it was no, that's just some club you belong to. You can't say my club says do this. Okay, now there is another thing here. So they withdrew from the engagement, and that's because the AICPA says you cannot be associated with bad people. However, there is another option they could have done. So here we have the, they found out that Medtrans actually lost $500. So they have on their books, their profits are 1.9 million. We know that's not right. The CFO resigns, saying the money part. The CEO did not change them. What could have the auditors done instead of withdrawing from the engagement? What do you do if you have a client that you find out that their financial statements are misstated, materially misstated in this case, and they're not going to change them? What can you do? Assuming you don't withdraw from the engagement. Well, we're required to give an audit report, right? So one of the options that they could have had here was to as they give Medtrans. Give Medtrans an audit report with an adverse opinion, right there. So we do have a mechanism if they don't make the changes, we tell them make the changes. They don't, we give them an adverse opinion. Now, this would actually, you're hired to give an opinion, an audit report with an opinion. And as long as you do that, you have complied with the state laws regarding professionals. So they probably in if you want to avoid lawsuits, I would say when you run into a situation like this, give an opinion that's adverse. And if they don't like it, well, they can change the financial statements. And notice in that adverse opinion, the adverse opinion will show and included in the adverse opinion would be the $500,000 loss. So in the adverse opinion, you say that the financial statements that the 1.9 million is not the net income, that actually it's a net loss of 500,000. It'll be included right within the adverse opinion. And sometimes, if you write that up, it might change their mind. Although it doesn't sound like this, doesn't sound like this person would change their mind, but it might change their mind and say, okay, we're fine, we'll make the changes. So one of the things you could have done is they could have done to avoid a lawsuit is to give an adverse opinion. But again, this case is very important because it established for not only the AICPA, but other professional groups that they can use their professional standards for their professional organizations rather than state laws regarding professionals can be used in court. This case gets cited all the time by many people. Okay, so we can turn that in. I think, yeah, I'm sure I got that in. Yep, Medtrans case. So we can just turn that one in. Okay, now let's go to Chapter 6. Handout, planning the audit. Okay. And the first thing we're just going to cover is the process of it. So planning the audit, this is what we're basically doing. This is Chapter 6. But from the plan, everything else comes from the plan. So we plan the audit and then we do the rest of the stuff. Get an understanding of the client. Let's make it green. Assess the risks. What could go wrong. Audit procedures. Do our testing like we do for sampling and all that. Complete the audit, which is kind of cleaning up the stuff, and then give an opinion. But all that comes from planning the audit. Basically, all this other stuff. How do we get an understanding? How do we assess the risk? What audit procedures? All that kind of stuff. Okay, so let's look at auditing in general. Auditing in general. Which of the following types of accounts would be the easiest to prove? We have revenues and expenses, that's on the income statement, and then we also have assets, liabilities, and equity. One of those is the easiest to prove because a lot of times you can actually put your hands on it, whatever it is. There's a tangible part to it. Which one of those is probably going to be the easiest to prove?
You're talking about assets?
Yep. Assets. So this would be the easiest one to prove. You can, well, first of all, cash, you can get a bank statement. Do the cash. Inventory, you can go look at it, count it up, see if it's, what kind of condition it's in, all that kind of stuff. Equipment, the same thing. You have, assets are the easiest one to prove. So this is usually where we start our audits, are doing the assets. Oops. So we start with our assets. They're the easiest to prove. Okay, so let's take a very important account, and that's cash. So cash, dollar-wise, a lot of times cash may be not that material. So the cash account here, so the significance of the cash account. Significance of the cash account is that it is, a lot of times it's not material, or it's not nearly as material as other things. Buildings, you probably have more wrapped up in a building than you do in your cash. So if you just look at the dollar amounts, you might say, well, cash probably isn't that important. Cash is actually very important because almost every transaction you can think of goes through cash. I mean, you really have to get creative to find a transaction that doesn't go through cash. If you buy inventory, you pay cash for it. Let's say you buy inventory on credit. Well, eventually you have that accounts payable. You have to pay that with cash, right? So cash gets involved in that. When you sell something, if they give you cash, obviously it's right there. But if they don't, let's say they buy it from you on credit, well, eventually you're going to collect the cash from that accounts receivable. So it's really difficult to find a transaction that doesn't involve cash. The only thing I can think of is if you trade something like, you have company stock for a building or something, whatever it is. But you have to get kind of creative to find something through the normal transactions that doesn't go through cash. So virtually everything goes through cash. Now, the nice thing about cash is that you can actually trace these things going through it. So, for instance, one of the things when you have revenues, it'll go through cash. If you sell something for cash. If you sell something on credit, like we just talked about, going to accounts receivable, and then the accounts receivable gets paid off, it goes into cash. And you have the same thing with expenses. You might pay expenses with cash. This one's going to be quirky looking. We'll go up here. So let's say that you have expenses, but you don't pay them yet. They're in accounts payable. Sorry, I think I'm going to sneeze. I don't want to startle people. Okay, and if they do go through accounts payable, how do you pay off accounts payable? You pay it with cash. Same thing with long-term payables. They go through cash. If you buy inventory, inventory is going to go through cash. Either you pay cash for the inventory or you have it for accounts payable, and that goes through to cash. Equipment, paid cash or through accounts payable. So everything pretty much goes through cash. So while you're proving cash, the cash account, you can prove a lot of the other accounts. So usually how you start out, I should take all these arrows out of here or not, but usually you start out with looking at cash and then you look at liabilities. Now notice the balance sheet has to balance. So if you can prove cash and you can prove liabilities, by default, you've proven the equity, right? If the assets are okay and the liabilities are okay, then the equity must be okay. So the first thing you prove are the assets. Next thing you prove are the liabilities. And again, a lot of these are easy to prove because they go through cash. Or easier to prove, I should say. And if you can prove those two, then the equity is okay. And if the equity is okay, then you also kind of know that the income is all right because the income goes into the equity. Ooh, I just goofed up my spacing. There we go. So the net income goes into equity, it goes into retained earnings. So if we proved out the equity account, you kind of proved out the net income. And, once you go through the assets and liabilities, you've actually completed most of the audit, and they're all interrelated. So while you're proving out the cash account, especially, a lot of times you're proving out all the other accounts that go into it, because most accounts go through cash. There could be some that don't, but for the most part, they're all going to go through cash. Any question on that? So auditors, we really beat up the balance sheet, especially assets. Cash is a very important account. And if we can prove the assets and the liabilities, that almost takes care of the audit, because while you're doing that, you'll be proving out all the rest of the stuff that goes with it. So we concentrate on the assets, and it's not just the cash. Accounts receivable, there's ways you can prove accounts receivable. There's ways we can, inventory, we do audits of inventory. We go look at the inventory and count them up and price them out. Equipment, we look at the equipment, go out and find the, all the documents for that, the vendor invoices and all this kind of stuff. So once we prove out the assets and prove out the liabilities, that's most of the audit are doing those two things. So it's very important. And the cash account is so important, even though it's a small amount. It's very important because so much stuff goes through it. We oftentimes will audit cash to 100% for two reasons. First one is that, like I just said, everything goes through it. Second of all, is a lot of times you can do it. You can get bank statements. So getting the bank statements, getting familiar with the payments and all that kind of stuff, you can actually do it pretty well. Okay. So a lot of times cash will be audited at 100%. I'll put that in there. Kind of looks funny, but a lot of times we'll audit that at 100% because we can, and because it's very important. Okay. Audit risks. Do we already do this? Do we talk about inherent risk and control? I think we did. Didn't we do it in chapter 5? Let me see it. Oh, it's in a different one now.
I think we did go a little bit over inherent and control risk.
Yeah, we did. Okay. I'm going to skip this. We already did it. And you already have it in chapter 5. And I think we already talked about it. When you're doing these risks, that you assess these two. That the auditor assesses these two. These are assessed. They're not changed. Oops. That is not a word. Okay. And detection risk, this is basically what we're going to do for the audit. This is the the detection risk is the auditors detecting what, and so this is the actual audit. This is the only thing we have control over. So we assess their inherent risk, the risk that a material misstatement will occur, control risk, if their controls will catch material misstatements. We assess those, but we actually have control over our audit. So the detection risk is the actual audit itself, and we can control this. Okay. Client acceptance. And this goes back to the Medtrans case. Hopefully you can avoid getting a client like Medtrans. There is an importance of going through it's different than other fields in that we don't just take everybody. If you're at a hospital, whoever walks in the door, you're required to take them on, as a client or a patient or whatever you want to call it. We don't do that in accounting. In accounting, or auditing, we pick and choose. And again, one of the things we don't want to be associated with are people of ill repute and that sort of thing. But we also want to see if we can do the audit itself. Okay, so client acceptance. Is the CPA firm qualified? Can the audit be completed? So this is probably one of the most important parts here. Can the audit be completed? And suppose it's an audit of that you haven't performed before. For example, let's say that it's an audit of a flower shop. Maybe they're a flower shop that supplies stores of flowers. You say, I've never done an audit of a flower shop. I don't know how to do an audit of a flower shop. Can I still take it? If you believe, honestly believe in that you can actually get the expertise to do it, and it could be the expertise could come from reading materials. It could also come from hiring people to help you who do know how to do audits of flower shops or whatever. But you don't have to actually be familiar, be experienced in the audit to take it. And if you think about it, it'd be kind of strange to get to perfect how to do an audit of a flower shop if you don't have any flower shop customers. If none of your clients run flower shops, why would you know how to do that? So it's perfectly fine to take an audit if you believe that you can get to the level you need to get to issue an opinion. And again, it might be obviously doing research, but also you may even bring somebody else in, someone else who's familiar with doing audits of flower shops, at least for the first time. All right. So let me write that out. The CPA firm may take a client that is in a business that the auditors have no in which the auditors have no audit experience. If the auditors believe, if they believe that they have the ability to necessary to perform the audit, if they believe they can get the knowledge necessary to perform the audit. And again, however they get the knowledge is open. And like I said before, it would be kind of strange to, if you don't have any clients in a certain industry, why would you learn how to audit in that industry? So a lot of times you will get, pick up new clients that you've never audited before, simply because there's no reason for you to have that experience before. Legal and ethical requirements, independence, other clients, lawsuits. This is all our Chapter 3 stuff. I'm not going to go over all of it again, but legal, ethical requirements. So are you independent and all that kind of stuff? Lawsuits, things like that. I should say handout. So are we independent? Do we have own any stock? Does anyone in our family work for the place and all that kind of stuff? Okay, integrity and reputation of client. This is very important according to the AICPA. In fact, probably one of the most important things. These are the two most important things for the AICPA are, can you complete the audit? And also the integrity and client reputation of the client. So the AICPA thinks this is a very important thing. Okay. Now, if they've already had audits, they'll have a predecessor auditor. Okay, so if they had an audit in the past, they may be bringing you in. Something weird happened to my screen just now. Okay, so they'll bring you in. One of the things you want to do is contact the predecessor auditor, and you're required to make the attempt to contact the predecessor auditor. So let's kind of clean this up a little bit here and see what the successor is and what's the predecessor. The successor is the new auditor. And the predecessor, is the old auditor. So successor auditor is the new auditor. So if you're the new auditor, the predecessor is the old auditor, and you must initiate contact with the predecessor auditor if one exists. If it's their first audit, they're not going to have one. By the way, you have to get the client's approval for this. So the client has to approve it, but contact the predecessor auditor. Okay, what are you looking for? There is an SEC 8K report that will have, among other things, the change of auditors. And here's some of the things, though, that you'll talk to them about. This is probably the most important one. According to the AICPA. The integrity of management. Can you rely on management? Are they good people? Are they not? And you want to know why the reason the change. It could be that they had a disagreement. It could be that they just didn't want to do it anymore, retiring or something like that. So here's some of the other stuff you're going to go through, but the integrity of the management is probably the most important one. Can they be relied upon? You may check with third parties, bankers, and that sort of thing, and do background services. These can be quite extensive. One of the things that is a no-no is what they call shopping for accounting principles. That's when a client is looking for a CPA firm that will agree with a disputed accounting principle. Okay, so here's what happens. you get, the auditors and the client, um, they get to pounding on tables. You can't do this. Yes, I can. No, you can't. Okay. So then they say, well, you're not the only CPA firm on the planet. I'm going to get somebody else. So they start calling around with other CPA firms, and they say, well, by the way, this is how we're accounting for revenue. Are you guys okay with that? And what they're doing is trying to find a CPA firm that will agree with some dispute they had with the previous auditors. And the AICPA really frowns upon this, in that they don't like CPA firm, the integrity of the CPA firms basically being bought by clients. So this shopping for accounting principles, this is strongly discouraged by the ACCPA. Okay. I think I have this on a separate page. Client continuance. After each audit, the CPA firm should Every job that the CPA firm should discuss whether the client relationship should be continued. Into the next year. So if you do have a problem with a client, you should, after each audit, you should discuss whether you want to continue with them. And it kind of goes back to that Medtrans case. If you finish up an audit with them and say, okay, we had a lot of problems or whatever, you want to give them time to get another auditor in. So you can't really do that while you're in the middle of an audit, withdrawing in the middle of an audit. But once you completed your audit, you could say to them, look, I don't think we're going to continue having you as a client. And then they have time to go get somebody else, to another CPA firm. So the time to do that is when, after you finish an audit, and see if you want to continue with the client going into the next year. And sometimes it's just not worth it, or whatever, whatever you come up with to do it. But the time to break that relationship is right after you do the audit. Is a good time to do it, to see if you want to continue with them into the next year. If you wait until they think you're coming in and next week, and you're not, now that they have a problem, and you could get sued for that. Oops. Okay. All right, let's do some questions. The attempt to communicate between the successor and predecessor auditor should be initiated by which one? Hey, you guys are sleeping.
It's the predecessor, right? Or sorry, the successor.
Yeah.
The one that comes after.
Yeah, the predecessor, the one that was there before, they have no responsibility any longer to the client, and they are not responsible to contact. They may not even know who the successor is. So the successor is always one that has to initiate it. Attempt to communicate should be made before or after? I'll give you this one. Before. So before you take the audit, you say, okay, I got to talk with your predecessor auditor. Now, you might run into the situation where they say, well, you know what? The predecessor, the other auditors we had before, they're a bunch of jerks. I don't want you talking to them. And if you need to charge more money to do more work, whatever, that's fine. But I don't want you talking to them. Those guys are a bunch of idiots. And, Now, what they're telling you might be true, but you still need to contact the predecessor auditor. So I need to tell them, look, yeah, you very well may be right, but we're required to contact the predecessor auditor. And again, that's a scope limitation. It could be that they don't want you knowing something that the predecessor auditor knows. And again, you can objectively make an opinion about, or a judgment, I should say, about whatever it is or the disagreement was, if they did have one. But anyway, you're required to do the predecessor auditor. Now, there are some times that you can't do it. The predecessor auditor died. The predecessor auditor left the country or whatever. They're in prison or so whatever it is. There are sometimes, there are reasons sometimes you can't do it. Physically you can't do it. You're legally or whatever. But generally you are required to make an attempt to contact the predecessor auditor, and it's made by the successor. And by the way, if the client does not give you authorization to contact the predecessor auditor, you generally don't take the audit. It's a scope limitation. Okay, which of the following would you want to know about the successor auditor would likely inquire about which of the following? Okay. Well, the obvious ones, disagreements with management. You're not going to probably look at the specific audit steps because you're going to have your own audit program that you're going to use. These next two would be in there. Oops. Communication with those in charge of governance would be in there. Reasoning for specific testing of accounts, probably not. But the big one is the obvious one is this one, and this is, again, this is the AICPA will tell you that this is the most important. Integrity of management. ACCT report. We didn't talk about this one too much. We didn't talk about it at all. All right. So I'll go over this now. Okay. The SEC ACCT report. Let me just stop and say what an ACCT report is. An ACCT report is something that's filed to the SEC whenever there's any kind of a change, a significant change in the company. Not just for auditors. It could be anything. So, the chief operating officer resigns. An 8K is filled out. This chief operating officer has resigned. 8K is filled out. They get a replacement, operating officer. Another 8K. Here's our new chief operating officer. 8K. Whatever. Anytime there's anything significant happens, 8K is filled out. We bought a competitor, we merged with a competitor, blah, 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 8K. Whenever there's anything that's significant, an 8K is filled out and it's sent into the Securities and Exchange Commission just to let the Securities and Exchange Commission know what they're doing. One of those things is if they change auditors. So if they change auditors, an 8K is filled out. And the 8K is really just the, just letting them know that there's a change happening. Okay, so change of auditors. That will be an 8K. They don't get into the reason for the change. And the reason for the change might be different among different, people. They don't talk about fees. D and E, significant disagreements for the last 5 years or 3 years is actually this one. It's 3 years. Oops. Hey. Okay, and F goes along with E. So it's disagreements for the last 3 years. And the auditors will respond to what the company has put in for their disagreements. So A, E, and F. So here's what happens. The company, they say we're changing auditors. They don't have to give a reason why. We're changing auditors. Here are the significant disagreements that we had over the last 3 years. The SEC will take those significant disagreements and send them to the CPA firm and say, is this everything? And it's a yes or no response. The auditors either say, yes, that's everything, or no, it's not. If they say, yes, that's everything, then it's fine. But if they say, no, it's not, the SEC goes back to whoever their client was and says, okay, you're not giving us everything because they said, no, there's been more disagreements. Keep talking. So it's a yes or no, whether they, whether those are all the disagreements on there. And again, the SEC will contact the auditors, the previous auditors, and they will say yes or no whether these are all the significant disagreements. Okay, which of the following considerations is important in obtaining new clients? Reputation? Obviously that one is yes. How about nationality?
That shouldn't be important.
Credit rating of the client. This one actually will be important. And the reason why this a client that is doing poorly, say, may be a higher risk. You know, if they're in bankruptcy or they're having money troubles, which there's nothing wrong. There's nothing to say that they can't make their financial statements correctly, but it does increase the risk. Marital status of the owners.
That doesn't sound important.
Pending litigation.
That sounds like it matters.
Independence of the auditor to the client. Yes, this is all chapter 3. Remember, we had you can't do this, can't do that. Oops. And the auditor's competence in the client's industry. Now, this is a consideration, but it might not, even if you don't have the competency, you can actually, be thinking you can get it, you can do it, but it is a consideration either way, right? If whether you're familiar with their, their type of industry or not, it is a consideration. And if you are not familiar with it, you can still take the audit as long as you believe you can get familiar enough to make an opinion. Okay, I'm going to stop here. Hey. let's go ahead and take a break. And we come back. When we come back, we will go into, no, not that. Sampling. Oh, I gave you this for homework and I didn't do it. Bad Marky. Okay, well, we come back. I'll go over this when we come back. But let's say be back at three ten. Well, I'll put this up right now. Okay, so this is what you should have gotten for problem number 3, I think. This is rounded, by the way. This is rounded also to the nearest sense. And again, the beauty of this, one of the beauties of the monetary unit sampling is that finding the sample size does 2 things. Finds the number of items you're going to pick, but it also tells you how you're going to pick them. Because the interval tells you you're going to go every 22,000, whatever it was, 22,123, this will tell you which ones you're going to pick. So there is no random number table or anything like that deciding which ones to pick. This will pick them for you. So you know how many and you'll know which ones. Okay. Get rid of this. All right, there are some wacky rules that come into play. I'm going to tell you how great it is, but there's also some kind of strange things that come into play when it comes to doing the monetary unit sampling. Incremental allowance. The idea behind incremental allowance is that when you do find an error, if you find an error in an interval, that there's that raises the possibility that there could be more errors. The more errors you find, the more errors are likely in the sample as a whole, right? If you don't find any errors, that gives you some level of assurance. But if you find one error, that also says, okay, there might be more errors in the sample. But the more errors that you find, the more likely that there are more errors. So when we're going through here, the incremental allowance says that we're going to have that if there are errors found, that means there could be more errors in the sample. It's more likely that there could be errors in the sample. It also tells us, though, another thing, in that we're not just looking at if there's an error or not, the dollar amount is also going to be significant. Okay, so that's the first rule about it. And we're going to have this incremental allowance, which we'll talk about later. Monetary unit sampling is only used for overstatements. Understatements are ignored. So if the audit value is greater than the book value, we ignore it. So not only is it only good for overstatements, we only count overstatements. And this is one that bothers, when you use this method, it kind of bothers you because you find an error and you don't do anything with it. Okay, this is understated. You forget it. Oh, wait a minute, it's wrong. It's wrong, but this method ignores that. Okay. If a misstated item is a book value that is equal to or larger than the interval, then the misstated difference between the book value and the audit value, actual misstatement. And these are not including incremental allowance. Okay, that's quite a bit, but let me share you what that one is talking about. What that one's talking about is if you have an item that is bigger than the interval. So for instance, on the last problem we have the interval of 22,123. So if you had picked an item that was larger than 22,123, in other words, there's a 100% chance it was going to get picked. Let's say you picked one that was 30,000. Okay, 100% chance it's going to get picked. And there's going to be a misstatement there. you're going to use the actual misstatement if it's more than the interval. There's not going to be any incremental allowance because it covers the entire interval. Nothing more in that interval could be wrong. The item covered the entire interval. Nothing else could be wrong in that interval. And I'll show you how this plays out here in a second. Okay, let's go through them. Book value of accounts. So here's the problem here. Oops. Book value of accounts receivable 800,000. Sample size 20 items. So that's how we got the 40,000. By the way, 800,000 divided by 20. And these were the following misstatements that we found. Now the first three are are normal. These first three we can just do like we normally did before. So 14 divided by 120. This will give us our projected value, whatever that is. So projected value is 28,000. Oops. More importantly, our projected misstatement is, what is it, 12,000? And this one would be included in the incremental allowance because the book value was 20,000 of the interval. There could be more things wrong in this interval. This only covered 20,000, covered half the interval, so there's another half of the interval. This would be included in the incremental allowance. Next one, 2400 divided by 3,000. And again, 3,000 is the book value. The interval is 40,000, so there could be more things that are wrong in here. There could be more. So this would be included in the incremental allowance. Zero divided by 1,700 times 40,000 is 0. And this would be 40,000. I'm going to say something about this one. So if you look it up, and if this one is 0 and they have it for 1,700, this is exactly what you do. I've read in some of the books that they will say that if there is a 0 in for the audit amount, that the auditor should see why it's a 0. But you do that anyways. You do that whenever you're looking through it as to why they're off, because you're looking at to also look at internal controls and things like that. So even though they say that you should do that for for this one, you should do that for all of them. So it's kind of an odd thing that they single out monetary unit sampling, but generally when you have a 0 for an account, you look into why they have it anyways. Or even for these other ones, why are these being misstated is a valid question. Okay, now these last three are wacky. So let's take number 4. What's wacky about number 4? This is an understatement. Oops. And if it's an understatement, we ignore it. There is no misstatement. And again, as an auditor, this bugs you. Wait a minute, this isn't right. Well, ignore it. All right, this one down here. The book value is higher than the interval. Eh. So the book value is higher than the interval. We will take the actual misstatement. Oh, no. And it's not included in the, let me do something here. So we'll take the actual misstatement. This is higher than the interval. There's a 100% chance it'll get picked, by the way. It's higher than the interval. We will take the actual misstatement of 33,000. We will not have any incremental allowance because this interval could not get any worse. This 44,000 covers the entire $40,000 interval. It could not get any worse. And the same thing is true down here. This one would actually cover two intervals, possibly three. So this would be 90,000 minus 65,000 equals whatever that is, 25,000. All right, so our total misstatements will be 118,000. Total book value was 800,000. Projected value would be 800 minus that. There it is. Okay, so wacky things. Understatements are ignored. If the book value is higher than the interval, we take the actual misstatement. We don't do the ratio thing. All right, let's do number 5 together. This kind of puts it all together. Kind of. You know what? Number 5. Oops. Why did I do that? Number 5 is similar to what you see on the CPA exam. When I was taking the CPA exam, some of these are actual problems. They actually had a few times they used the actual layout that we're doing for number 5 here. The CPA exam. I don't know how much they tested recently, but when I was going through, this is how they would show it. Okay, so items found. The interval is 50,000, and we have the first one is the audit values 8 and 10. Take that ratio and times 50. Projected value is 40,000. This statement is 10,000. The book value is less than the interval, so this will be included in the incremental allowance. Book value is less than the interval. Okay, second one. Same thing.
We can't see your screen present.
I'm so sorry.
Oh, good.
No, it's not. Wait, did you guys see this one or no?
Yeah, we saw that one. Yeah.
Oh, okay. Sorry about that. So this is the yeah. So the first one would look like this: 8,000 divided by 10,000, and this 10,000 is less than the interval. And this is important because there might be more things wrong in the interval, right? This only covers 10,000 of it, so there's another whatever. So this could be so that we're going to include it in the incremental allowance, which we'll see what we're going to do later with that. Okay, 1,600 divided by 4,000 times 50. So the projected value of that is 20,000. And so the projected misstatement is 30,000. And again, there could be some more things wrong in this interval. The book value is only 4,000, so there's another, what, 46,000 in the interval, so more things could go wrong. So we'll include that in the incremental allowance, saying there might be more problems in there. This we can ignore. Why? This is actually an understatement. We're saying it's 2,100, they're saying it's 2,000, so this is an understatement. And so we're going to ignore it. And again, this is one of those things, as an auditor, it bugs you, but and there is no incremental allowance because there's nothing wrong with it, according to this method. Okay, so the projected misstatement will be, all those together. So 10,000 plus 30,000 plus 0 is what, 40,000? Oops. And so this is our best estimate of what this is off by. But because this is a sample, it could be off by more. This is what we think. Our best estimate is it's off by 40,000. But it could be off by more than that, because we are not taking every single item in there. We're just taking a sample of it. So as we're taking a sample, it could be, I get that bell curve thing going on. Okay, basic precision. I thought we gave a formula for that. Here we go. All the way at the end of the, go to page 8. I'm going to copy basic precision calculation. Note to self, I should put that in up here. Oh. Okay. So basic precision equals interval plus reliability factor. Okay, so I am going to our interval is how much? $50,000. That's right, it's 50,000. So 50,000 is our interval. Let's see here. Our reliability factor. Reliability factor is at 5%. Oh, you know what? I actually have this here. The spacing very well on this thing. Okay. Our reliability factor is going to be at 0 misstatements. Incorrect acceptance for this is 5%. At 0 misstatements, 5%. This is going to be 3. 3. So the reliability factor, 5%. I should say 0 misstatements. Look funny. Okay, so our basic precision is going to be 50,000 times 3. 150,000. So what does this mean, basic precision? Basic precision is the amount that it could be off by, even if there were no errors found. So if there were no errors found, you would still have this basic precision because it's a sample. I should say no misstatements. So even if you had no misstatements, you would have to tack on another 150,000 onto the upper limit because it's a sample. We didn't take everything, and so there's a possibility that it could be off by more. Okay, now, part I hate teaching the worst. This is this one. This is really wacky. It comes from a reliability table, and we have to get an incremental factor. And so we're going to do that first, get the incremental factors. And I'll just show it to you. There's no easy way to do this. Okay, so incremental. At 5%, we're going to take the factor at overstatement 1. Minus overstatement 0 minus 1 will give us a factor. Point 0.75. We're going to do the same thing for number 2. Number 2, overstatement number 2. Okay, so I'm coming down here. 630 minus overstatement 1, which is just the 475. And we'll get another incremental factor. .55. Now, if I ever write an auditing book, I'm going to have a table of the incremental factors, because if you think about it, if we have this table, we could make a table of incremental factors easy from it. And we wouldn't have to do this calculation at each time. But anyway, this is an incremental factor. Now, what do we do with this? We go to our misstatements up above, and we'll get the largest misstatement first. This is where these incremental allowance comes in, the incremental amount that more could be wrong. Now we take the largest one first. So we have 10,000, we have 30,000. We're going to take the largest one first, so the 30,000 will go first. This is the largest. So 30,000 times 0.75, some number. 22,500. So this is telling us that, look, there could be more things wrong with this account, and the amount of it that it's off by matters. So we're gonna take the largest one times the largest increment here of 75. We're gonna go down the list here. There's the second one is 10,000. Second largest. And was it 5,500? We don't, if there was a third one, we'd do a third one. This one shows a third one, but this one's 0. And even if there was, this would, if it's 0, it's 0 times anything's gonna be 0. But the incremental allowance is going to be these numbers added up. So, what is that? $22,000, $27,000, $28,000. So we're saying that these books could be off by another 28,000. I'm going to move this one up. Calculate the upper limit on the misstatements. Yeah, maybe I'll leave it here. I don't know. I know what I'll do. I'll copy these down. Okay, so calculate the upper limit on the misstatements. So the upper limit would be all three of those together. Whatever that is. 190, 218. So this would be our upper limit. So our best estimate is that it's off by 40,000, but it could be off by as much as 218. So the 218 is what we'll consider when we think about whether it's material or not. Let's stop right there. All right, we'll do this one next week. So next week we'll finish this monetary unit and probably finish the other handout too. Okay. Get a screenshot of that. And down here, maybe a screenshot of that. Oops. And yeah, this one was similar to what they had this on the CPA exam a couple times. It was similar to this. We'll do this one next class. Okay. Well, I will. You guys have any questions? I know there's a lot there. We'll do it more next class, and we also have a practice exam for sampling, so you see that at least twice more for the test. All right. Any questions? Okay. I think we've all had enough. I will see you guys in a week's time.
Thank you, Professor. Take care.
Thank you, Professor. Have a good one.